Okay, so today we're going to talk about the five wealth building principles of investing in commercial real estate. And this is kind of a conversation that I've had over the last probably 2 or 3 weeks with various clients and people that have just kind of wanted to get on a call with me and kind of talk about their plan for investing in commercial real estate. And I thought what I would do is I would kind of go through a little bit like a very condensed version of what I call or what we go over in call one with my clients. And that is getting like really clear on your financial blueprint. And then secondly, we're going to go into like a live deal breakdown, if you will, on really what can happen when you kind of uh, hold a property for a long period of time. So the first thing that I want to really talk about is setting targets in commercial real estate, because I think the big thing that I find with new clients that are kind of that have maybe invested in the stock market or residential properties, and they really don't know kind of the proper expectations. And so I think the biggest thing is having kind of a clear idea of where you want to go, where you're starting, and then developing this really, well, we'll see here in a second. So if you're listening to the podcast, obviously, I've got kind of my whiteboard in behind, but you'll get the gist of it here. You can always go to YouTube and watch this later. So what I've got is basically a straight line with point A being where you are today, and that is your reality. And NW stands for net worth, and CF stands for cash flow. And you can really use cash flow as basically how much you're earning either in active income and passive income. We really didn't talk about that here, but it's important because the target that we're going for is to convert your active income into assets that are paying you passive income. Okay, so that's the reality. And where we're going for, I call it your target. And your target is really what net worth do you want and what cash flow do you want to generate from that? And one of the mistakes that I see a lot of new investors is they really focus on generating cash flow where they really don't have kind of a substantial net worth. And you'll see how having a larger net worth kind of reduces your risk down the road. I made this mistake. I focused exclusively on cash flow when I first started. And the challenge with that is when you have kind of when you don't have your foundation of a net worth that's substantial, then you end up taking significantly more risk. And I'll kind of demonstrate that here in a little bit. Step three, from going from point A to point B, which is where you want to get to, is really kind of this plan. And I just drew a bridge here because the bridge is like getting extremely clear on how you're going to get there. Because it's one thing to say that I want to have a net worth of $10 million or $20 million or whatever that number happens to be, and I want to generate $300,000 a month or a year in passive cash flow. But like, how does that all happen? And so really it comes down to a few different kind of what I call variables. And your variables are going to be your time, your resources, the amount of risk, and how you kind of handle your emotions as you go through all that. So that is essentially the big picture. And I think what is important is to maybe just give you kind of like, we've already defined the why, which is we're looking to replace active income with passive income through the acquisition of cash flowing assets. And I thought what I would do is just kind of, this might be a bit of a reminder, if you will, or something that we've talked about in the past, but I think it's still valuable because, you know, if you haven't listened to the podcast in a little while or watched this, having kind of these 7 primary reasons for why commercial real estate, because if you don't believe commercial real estate is kind of an asset class that you should be invested in, then what happens is you'll look at stocks, you'll look at residential, and my job, if you will, is to sell you on the fact that commercial real estate, or at least why you should consider commercial real estate as a part of your overall investment portfolio. Not suggesting that it needs to be all of it, but I think that certainly a percentage of it is a good idea. So the 7 primary reasons why I like commercial real estate are: number one, cash flow. I don't want to get like I've got like a whole presentation here that could easily be 30 minutes long, and I don't want to go too deep. But I can tell you that most of the properties that I invest in are going to generate on the low end 6% and definitely north of double digits in cash flow if you're buying in the right areas and the right properties. Compare that to dividends, and I just did a quick search just to see kind of I mean, for me to just say it is one thing, but then I wanted to back it up. So I went online, and obviously you can probably find stats that support anything. But on Investopedia, which is a pretty reputable website, they said between 1871 and 1960, dividend paying stocks on the S&P, which are like the largest companies in the US, paid an average of 5%. Between 1970 and 1990, they paid dividends of about 4%. Between 91 and '07, they paid 1.95%. In 2008, for whatever reason, they just picked that year, those companies paid about 3%. And then between '09 and 2016, they paid 1.99%. So the reason I say that is if you're getting a 6% rate of return on a commercial asset, you can see how that can potentially be superior to what you would get even if you're getting dividend paying stocks. Obviously, the tax advantages or incentives. This gets a little more complicated, and what I will just say is that I don't want to get into because as soon as you get into depreciating commercial assets, there's a whole conversation on what's your tax bracket and whatnot. But just understand that for most commercial properties, you're really able to drive down whatever your tax consequences are through depreciation. On commercial properties, you're able to depreciate them over 39 years. So that's about 2.56% of the actual property, not the land, because you can't depreciate land. And then on a multifamily, you're able to depreciate it over 27 and a half years, which is about 3.63%. So you can see if you've got a $2 or $3 million property, that 3.5% a year on a multifamily or 2.5% on a commercial adds up very quickly. The third reason is deferring taxes. And in the US, you've got 1031 exchanges, which essentially allows you to sell a property and then roll that into a larger property. In Canada and the US, you're able to refinance, you're able to pull your equity out and put it into another deal. Once again, I'm not an accountant or lawyer, so all this is just experience that I've had. For specifics, talk to a lawyer, talk to an accountant. I'm just giving you the big picture, if you will. Okay, so I don't want to get into the weeds because literally you can debate and negotiate everything. This is just principles and high level thinking, if you will. The fourth is leverage. And I'm going to demonstrate on, when we get to it, I'm going to show you what I think is a really kind of cool demonstration on how leverage and capital appreciation combined can really push your yield a lot higher than like even when I did the exercise, I was pretty blown away. Now there's going to be some key assumptions. I'm going to tell you what those assumptions are because I don't want you to just accept what I'm saying as gospel, if you will. But you'll still see that even with some pretty conservative assumptions, the numbers that you can get with leveraging and not crazy leverage, right? This is going to be based on 30% equity, so about 70% leverage. So those are the kind of 4 common reasons that most people talk about investing in commercial real estate. I'm going to give you 3 reasons that I like it that are kind of separate from the conventional, or I guess less common. So number 1 is really what the name of my podcast is, which is the investing advantage. And that is the idea between inefficient markets versus efficient markets. The stock market, because information on all the companies, it has to be disclosed. It's very hard to get what I call like an arbitrage opportunity, where in commercial real estate, that is like when you get into commercial real estate and you understand it, you understand, or what you'll notice is the people that do very well have like intel and knowledge that other people don't have. And I mean, I'll give you one quick example. I know of a company, we'll just say a company, even though it's a privately held company. And because they are well known in this particular market, I don't want to give it away too much. They were contacted by a broker because the seller needed to exit a deal to free up liquidity or equity to put into another deal. And because of this, this particular owner got the first phone call. So inefficient, right? It's not being broadly marketed. And they were able to come up with about $7 million plus or minus in 2 weeks, maybe even less. So the due diligence, and there was a high level of trust. They understood the market, and they were able to buy that property for, call it $7 million, all cash, no debt. And basically the next day, if they wanted to turn around and sell it through kind of more conventional means, meaning going to the market, proper bid situation, letting someone get debt, they could probably generate anywhere from $5 to $6 million in profit. Now that only happens because of this inefficient and getting the first phone call essentially, and being known in the market as someone that can do that. So do they happen all the time? No, obviously not. However, to make $5 million in a matter of a week or 2 weeks, you really don't need to do too many of those deals. So just that stuff, those type of opportunities do happen. Number 6, I call like confidence and certainty. And in commercial real estate, what I really like is, like, let's say you just had a 20-unit apartment building and you owned it for 10 years and you had kind of 95% occupancy. Well, if you're earning and generating an 8% cash on cash, you know that if you put in $500,000 up front, that you're going to be receiving $40,000 a year in free cash flow every year. That doesn't even include how much your mortgage is being paid down, which is probably going to be another $40,000 to $60,000 a year. It doesn't include any capital appreciation. It just gives you that comfort and certainty that as long as you maintain your property and you're going to be collecting that cash flow, if you will, from your tenants, that you've got certainty that money's coming in. And I think that that's one of the major reasons that I like commercial real estate, and the people that, obviously kind of believe what I believe and follow suit, they really like about it. Number 7 is control. I think I've talked about this in the past, but I'm just going to basically reiterate it really quick. And that is, in a commercial transaction, in a property, if you will, I'm able to influence the rents, expenses. I'm able to create value. And one of the key concepts is called forced appreciation, which I'm going to talk about here in a second. And when I compare that to the market, where I have very little control over a company, I feel like I'm like a bystander, just accepting whatever the market gives me in the stock market. I'm not saying that that's always a bad thing. Personally, I just prefer to have more control. So with that said, let's get into the 5, the wealth building plan, if you will, right? So we've already talked about defining where you are and then where you're going to get to. And what I want to talk about now is kind of like the 3 main objectives for most investors. And that is either cash flow, net worth, or legacy. And when I kind of break those down into the 3 different buckets, and I've talked about this in the past, you've got bucket 1, which is making money, bucket 2, which is growth, and bucket 3, which is legacy. And so legacy is really keeping your money. Cash flow and net worth really fall into either making money or growth. And so, okay, so let's get into the 5 wealth building concepts, if you will. All right. So this is an example, and what I'm going to do first is just set this up a little bit, right? So you've got, let me just kind of find it here. Okay. Okay. So we've already talked about that. Okay. So basically the 5 concepts that I want to discuss are: number 1, purchasing cash flowing assets. Number 2, using leverage properly. Number 3 is forced appreciation, which we're going to get into. Number 4 is disciplined investing. And number 5 is purchasing properties with kind of the right legal entities, right? So that you can really defer your taxes. And I don't want to get into that because I'm not an accountant. But those are kind of like the five uh, wealth building concepts, if you will, for commercial real estate. And what I want to talk about, because it seems to be maybe the least understood, and that is forced depreciation, which is really like how do you push the value of a property up? And really, it comes down to increasing the net operating income. And there's multiple ways to do that. So I'm going to talk about that here real quick. Okay, so the 7 ways, there's probably more than that, but let's just say that there's the 7 I was able to come up with quickly for increasing the value of your investment. Number 1, negotiating. Just by having kind of skills to negotiate a good deal, you can easily save 5 to 10% on a property. Not easily. I don't want to make generalities. It's quite possible to negotiate down a very good price. Number 2 is finding deals others don't have, and they could either be off market or direct. Just like the example I mentioned, where a group that I'm familiar with, that was an off market deal that came direct to them. Number 3, you can renovate, so you can attract higher quality tenants. Number 4, you can expand, right? Let's say you have land or a property with a building on it that has excess ability, or you can go up, right? One of my clients right now, one of the things, a few of the things that he is doing, I just thought of this right now. When you talk about forced depreciation, and this is a gentleman that is very new to commercial real estate, bought a very small property, but negotiated hard, got a great price on it, found a deal that others had not seen. He's now renovating it. He's expanding. He's going to go vertical on it. He's going to increase the rents. Actually, it's vacant right now. So number 6 is filling the vacancy. So because it is vacant. And number 7 is reducing expenses, even though that's not usually something that I focus too much on. But because this gentleman has a background in construction, he's going to be able to kind of make it more energy efficient. So, drink of water here. Actually, it's my greens. Okay. Now, what do I want to talk about here? This is the example I want to basically describe as it relates to capital appreciation. This is a concept that I really don't talk about very much because, frankly, the biggest assumption that you're going to have as it relates to capital appreciation is this, which is the rule of 72. And the rule of 72 is really talks about compounding value over time. So in the stock market, they'll talk about if you get a 7% return using the rule of 72, your money would double every 10 years. So basically it's 72 divided by whatever the return is going to be. So if it's 7%, 7 divided by 70, 72 divided by 7 is 10. In this case, I tried to use something that is, probably, I was trying to find proof, but I wasn't able to find it on the internet. So if someone has statistics or information that will show what the capital appreciation is for commercial real estate over, a reasonable amount of time, please send that to me. Either you can put it in the comments below on Facebook, YouTube, or on the podcast. Really, I just like to know what the facts are. But for this demonstration, let's just use 5%, excuse me, as our capital appreciation. And you're going to see how just buying a $1 million property, I use 1 million, it could be $500,000, it could be 10 million. Just with, 1 million is kind of probably a reasonable number for a commercial property. Okay. So we're going to assume $300,000 of equity at 4% on a 25-year AM. We're going to assume debt of $700,000, so 30% loan to value, 70% loan to value. And we're going to assume a cash on cash of 6.5%. Okay, so these are the kind of like the going in numbers, which I think are all very reasonable. The biggest assumption here is the 5% capital appreciation, right? So essentially, every 14 and a half years, the property will double in value. So if we accept that as fact, and I will tell you that when you look at most, especially on the residential front, because this is the biggest thing that because most residential properties are not going to cash flow with this type of with these type of numbers. And frankly, most residential investing will have generally less equity involved too, right? But on a commercial property, this is all reasonable assumptions, I would say. So the results, you're going to generate, this is after debt, about $21,000 a year, right? $20,500 in cash flow. Now, if you take that out 14 years, assuming no other, that basically your rents just remain flat, okay? You're going to collect $289,000. Debt reduction is going to be $306,000. So if all you did was just collect your cash flow and pay down your debt, this property would generate $595,000 or 14.1% over 14 years, right? So in 14 years, you can have doubled your money essentially, right? Because you put in 300,000 and you're going to get 595 back. Now, if you factor in capital appreciation, if you buy into this, and that's why I did this line item separate, your capital appreciation is going to go up $1 million, right? Because we bought a $1 million property. The property is going to go up $1 million, so it's going to be worth $2 million. So if the property goes up $2 million, your return on investment now is a $1 million uptick in value, $595,000, which is going to be your cash flow that you collected, which is $289, plus your $306,000 in debt reduction. All of a sudden, you've got $1,595,000 in equity, or about a 37.98% in return on investment over 14 years. So this is why, now, like I said, capital appreciation, that's a big kind of factor here. And I don't tell you that you're going to get 5% a year. I'm not suggesting that there's not going to be any vacancy or that there's going to be any kind of capital repairs that you have to do. I get all that. What I'm trying to do in this illustration is just show you what's possible when you hold a property for a long period of time, right? You don't sell. In this case, it's 14 years. I mean, if you have one or two of these properties, you can see how over a 10 to 15 year horizon that you can, back to what we talked about initially, replace your active income with passive income. So that's really what I wanted to illustrate today, because I don't ever talk about capital appreciation. It's not something that I really get into, but I felt that I probably wasn't doing you any favors by ignoring it, because it's quite likely that over time, just with inflation going up 2.5% a year, if it goes up 2.5% a year, this goes to 30 years. So even if it's 30 years, I mean, you can start to see that the numbers still look pretty lucrative over time. So that's what I wanted to talk about today. If you enjoyed this, if you would like me to go into more detail on how these kind of things play out, I'm happy to do that. Just either leave a comment. If you're watching on YouTube or Facebook, you can just leave a comment below. Tell me what you enjoyed, what you learned most about this particular episode. And obviously, if you're on the listening after on the podcast, if you enjoyed it, appreciate a 5-star review. And what was your biggest takeaway from this episode, if you will? So that's it. As always, this week, if you'd like, you can get a copy of my book, Club Syndication, at no charge. You can just go there, clubsyndication.com, and enter your name and email, and I'll just send you a free copy of my book, as well as a few other kind of bonuses, if you will. So that's it for today. Hope you enjoyed the show, and I'll be back next week. Bye for now.